Life insurance. It sounds so complicated, right? But what if I told you it really just boils down to choosing between two pretty simple paths? In the next few minutes, that's what we're going to do. We're going to walk down both so you can see for yourself which one is the right fit for you. Okay, let's just get right to it. It's a heavy question, I know. But honestly, it's the whole reason we're even talking about this. At its heart, life insurance is just a financial safety net for the people you love, for a time when you can't be there to provide for them. And the good news is, finding that answer isn't some kind of confusing maze. It's really just a journey down one of two main roads. And we're going to explore both of them together so you can see exactly where each one leads. So first up, a question of protection. Getting a handle on these two paths is absolutely the key to making a decision you can feel confident about for your family's future. All right, let's explore our first path. This is term life insurance. And a really great way to think about it is, well, it's insurance designed for a specific season of your life. The secret is right there in the name, term. This policy covers you for a specific chunk of time. Maybe it's 10, 20, or even 30 years. And because it's not meant to last forever, it's the most affordable option out there. You get the most bang for your buck, coverage-wise. You know the best way to wrap your head around this? Think of it like renting an apartment. It's super cost-effective, it's flexible, and it protects you for the exact time you need it. You're fully covered while you're paying, but just like rent, you're not building up any equity. So who is this really for? Well, picture this. A young couple just bought a house with a 30-year mortgage. They need to know that's covered no matter what. Or maybe business partners who need to protect their company if something happens to one of them. See, these are specific, temporary needs, which makes term insurance a perfect fit. Okay, let's switch gears and explore our second path. If term is for a season, then permanent life, as you might have guessed, is designed for a lifetime. Just like the name says, this coverage is permanent. It's designed to be there for your whole life. And here's a huge feature, the guarantee. Your premium gets locked in. It's level, and it is guaranteed to never increase, no matter how old you get or what happens with your health. So if term is like renting, permanent insurance, well, it's like owning your home. It's a bigger long-term commitment for sure. The payments are higher, but you're not just paying for protection. You're also building up real value, like equity inside the policy over time. And that owning analogy gets even clearer with a question like this. Because with some types of permanent insurance, you can actually do that. Imagine paying off your mortgage in, say, 10 or 20 years, and then living in the house payment-free. You can set up some policies to work the exact same way. Let's look at a real-world example here. Meet Paul. He's 46, and he gets what's called a 10-pay policy. He pays his premiums for just 10 years. So from age 46 to 56, he pays. Then, at age 56, he's done. He never has to write another check for it again, but his $100,000 coverage is fully paid up and stays with him for the rest of his life. Pretty cool, right? Now, we mentioned building value, and this is where permanent insurance gets really interesting. It has this feature called cash value, which is probably the most powerful and honestly the most misunderstood part of the whole thing. So let's unpack it. You see, whole life policies come with these three core guarantees. The first two are pretty straightforward: a death benefit that's guaranteed and a premium that's guaranteed to never go up. But it's this third one, the guaranteed cash value, that completely changes the game. So what on earth is it? Well, think of it this way. A piece of every premium payment you make goes into a little savings bucket inside your policy. And that bucket is guaranteed to grow, tax-deferred, over time. This is the value you're building, the equity in your policy. This really shows you the key difference. The death benefit, that's for your family after you're gone. But the cash value is what we call a living benefit. It's a resource that you can potentially tap into while you're still alive. Okay, so we've walked on both paths. We've seen the temporary, super affordable route of term and the lifelong, value-building route of permanent. Now let's put them side by side, so choosing your path is crystal clear. This table just puts it all together, plain and simple. Term is temporary, has a lower premium, and its number one feature is affordability. Whole life is lifelong, costs more, but its key feature is that it builds up that cash value. You see, it all comes back to that one question. Are you looking to rent your protection for a while, or do you want to own it for a lifetime? At the end of the day, there's no single right answer for everybody. There's only the right answer for you. It's not about which path is better. It's about which path better aligns with the financial journey you and your family are on, right here, right now. And that's really the question to take away from all this.